Hello good people, it's me Kumetila Kositile, your money manager. Today I want us to talk about equity release as it relates to your home loan or your mortgage. First things first, let's understand what equity is and how you build up that equity on your mortgage or on your home loan. So let's define equity. Equity is the difference between your property's market value and the loan balance. So this is how you get it. Your property market value minus the loan balance, that difference is what we call equity. The question is, how do you build up this equity on your home loan or your mortgage? Two ways of how that equity is built up. One is through amortization. What do we mean by amortization? You know, as you get that property loan or the mortgage, you are going to have that monthly installment that you'll be paying. So that monthly installment, part of it is going to pay the interest on the loan and part of it is going to use your loan capital. So as you pay every month, your loan capital is reducing, and that reduction is what is building equity on your home loan. Hope this is clear. Amortization. The second way of building equity on your loan is through what we call appreciation. Appreciation of the value of your property. As is commonly known, property, it does appreciate in value over time. So through that appreciation, it can be appreciating at a certain percentage. That appreciation is the growth in value of your property. That's the second way of building equity on your loan. So this difference between your property market value and the loan balance that we call equity, when you access it in the form of cash, that is what we call equity release. And for you to get this equity, to release this equity on your property, you go through the normal process of applying for a loan. So first, your financier is going to assess your affordability before they can give you this money. So you go through the normal process of applying for a loan because you're trying to access extra money on your home loan. So like we always do, we always explain our terms, our financial principles using examples or scenarios. Let's go through a scenario of equity and equity release. So let's assume that you took a 500,000 mortgage 10 years ago, and this is a 20 years term mortgage priced at 7.26%. And the installment on this mortgage is 3,955. So as you pay this installment every month, your loan balance is going to reduce. As displayed on the screen there, that is how your loan balance is going to reduce annually over a period of 20 years or 10 years. I've just shortened it to 10 years. Let's assume that on the 10th anniversary of your mortgage, you decide to evaluate if really you've built up an equity that you can release to go and do something with the money. So we look at the current loan balance, and your loan balance based on what you have been paying. Principle number one, amortization. Your loan balance is standing at 336,723 pula. That is your loan balance at what? As at year number 10. So you can now realize that you took a mortgage at 500,000 and your loan balance is sitting at 336,000. So that difference in there is the equity that has been built up through amortization. This is the first thing that we explain. So we need to appraise the property to get the current market value, and the appraised market value of our property is 740,122 pula 14 pebe. We are assuming here that our property is appreciating at an annual rate of 4%. Very conservative rate that we are using here, 4%, and that is what we get. Now realize the difference between the current market value of your property and the original price or the original value of the property, which was 500,000. We also have a difference there, which is about 240. That difference is because of appreciation, and we call it capital appreciation over the 10 years that we're looking at. So now let's look at the equity that we have on this particular property. Remember how we calculate our equity. We say the current market value of our property minus the outstanding loan balance. Our current market value of our property is 740,122.14 Thebe, minus our outstanding loan balance is 336,723 Pula 2 Thebe. So the difference between these is 403,399 Pula 2 Thebe. That is our equity, and this 400,000 equity is made up of two things: amortization, and amortization there accounts for 163,276 Pula 98 Thebe, which is the difference between our original loan minus the current outstanding balance. That is what we get. And then the other part is made up of appreciation, which is 240,122 Pula 14 Thebe over the 10 years period. That is your equity. So you have over 400,000 that you can access from this property. So when you go and apply to access this 400,000 money, that is what we call equity release, explained in a nutshell. So before I can end this video, I always want to say that do not use your property as an ATM. If ever you take a decision to go and release equity on your property, make sure that you use that money to buy a cash generating asset. Don't take that money and go and buy liabilities or depreciating assets, because you have reset your debt clock and now you have this loan that you've taken to 740 that you have to pay over time. So you rather take the money and buy an asset, a cash generating asset that will help you to pay off this loan. Hope is very clear. This is all that I wanted to share with you today. Please don't forget to leave a like and a comment for me, and thank you very much for watching. I will see you in another video.